Sweet.
There you go.
What is up, everybody? Erik here. Welcome back to All the Outliers. And I got my friend Michael Guyed from Lead Lag / the attack sphere of ETFs. You and I have, known each other for a while now. I always love getting a chance to pick your brain, talk about markets and whatnot. So first off, welcome on. Stoked to have you here, man.
Dude, you are the outlier, so I'm stoked to be on it. Come on now.
I feel like somebody was telling me about this thing of like manifestation, which it's always been so weird to me, right? To like just think of something and then all of a sudden it happens. And I've tried it and it's not fucking working. So maybe I need to manifest harder and then I can become like an actual outlier and be like one of these dudes with a $200 million yacht. But, we're working on it. At least we'll talk about it.
Listen, I'm trying to manifest a credit event, if you haven't noticed. And that shit has not been working apparently either on my end.
I guess that's actually like really true. I'm laughing pretty hard at that because if I look back across your Twitter feed, it is filled with said. What a great spot to start. So for the people, at least from my audience, that might not be familiar with your, I don't want to call it an obsession, but we'll call it an obsession with a credit event. What is the thesis behind this? Because for those that don't know, I've actually read pretty much all of your white papers, and the stuff that you think about, it's not like a lot of people speak in hyperbole for attention, right? And you get it, there's always some showmanship. But when I read through your stuff, it's like very clear that you are connecting dots. So talk to me about the credit event.
No, the showmanship and loudness on X is obviously not like the real professional stuff that I put out there, as you know. Look, first of all, it's funny because people forget that I was bullish at the start of the year. I was saying melt up. There's a whole thread I put out January 13. I said melt up or crash, and yes was the answer put in the post. I said Fintuit can't understand path. I believe we see both this year, right? So I was saying you're going to have a melt up because it's pre-election years, but towards the end of the year, there would be a heightened risk of a credit event, which, would be in response to the lagged effects of the fastest, greatest rate hike cycle in history. Okay, now, I think I've been right and wrong, as is the case with most things, in the way that it's played out. You did have a melt up, but only in large cap tech. So you can say, okay, that was right. You did not have a melt up in everything else. The S&P 493, small caps, retailers, Europe, emerging markets. There's been no melt up outside of those large cap names. So I'd say that I was actually very wrong in that melt up argument. And the whole melt up argument at the start of the year was it's a pre-election year. Pre-election years are factually, historically, the strongest of the cycle. Now, let's talk about the credit event. Credit event is not some scary term. Credit event just means a VIX spike. That's all it is. So when you look at the VIX volatility index and you overlay credit spreads, you tend to see there's a one-for-one relationship, meaning as the VIX spikes, credit spreads tend to widen. Not my opinion. Right? Volatility is seen by the bond market as increasing default risk. So again, part of the thesis was at some point the lagged effects would kick in. The Fed likely over-tightens, which, by the way, now long-duration yields are telling you that they did, which we can maybe touch on in the last several weeks here. Instead, you ended up having a credit event in treasuries, right? Which I then changed my tune and saying that's phase one, but a corporate credit event phase two has not yet happened. I thought it would start entering November. Now, the reason I said at the end of October that the first week of November you could see circuit breakers, which obviously I was way wrong on, right? Was credit spreads are starting to widen. Okay, the VIX was at a point, it was like 21. It was at the point where it's like, if it's going to break out and spike, it's around this level. So let me make a communication bet and say, okay, well, what if I'm right? And it so happened in my own funds, the signal said, be in treasuries. Treasuries worked that week. No circuit breaker. Best week of the year for the S&P. And then you had this drift, and now everyone's super bulled up, right? But I don't think the credit event risk has gone away. Maybe my timing, not maybe, obviously my timing has been off in putting a spotlight on it for entering November. But we don't know where these lags actually start to impact the economy and the stock market. I mean, you're already seeing it now in housing, right? You're starting to see the housing side break down finally on home sales and pricing. But to say that just because it hasn't happened in a single month, which I thought was higher risk, that the risk is still not there, to me is silly, because the thesis has not changed. There are lags. We went through the faster rate hike cycle in history. At some point, that will manifest. Speaking of manifestation, probably manifest in an ugly way. But path matters more than prediction. I've been wrong. Haven't necessarily made money or lost money, or I should say, on that, because if you were in treasuries the last month, you did great. Treasuries would have been the credit event way to trade it anyway. So it's fine, right? But it just goes to show you how this is a business where it's a fine line between being wrong and being early.
Yeah, well, and I also think it's interesting that you look a lot at path dependency, because I find in markets, I have a stats background and I spend a lot of time looking at these things as well because I find them interesting. And sometimes I feel like the path can be misleading when it's kind of overlaid with some of these unnatural add-ons. Specifically, like you're talking about a lot of the Fed's actions, which I've always been so curious how to even think about that, because we've never seen anything like this before. So it's like, how can you think about applying typical like path dependency into this kind of environment? How do you think about that when there's like truly anomalous conditions like this?
No. And actually, you're hitting on why I just, the reality is nobody knows. Not me, not you, not anybody that's listening, right? Because we've never seen anything like this, the fastest rate hike cycle in this way, right? So even the Fed can't model out the lags. They themselves have admitted that. And that's my point. It's like, if we agree that we've never seen anything like what we've gone through, then maybe it's bullish, maybe it's bearish. But one thing is that I can say for certain is that it's not certain, right? I mean, and that's sort of the mindset. It is funny to me, I get all this like anger and hatred for pointing out. People say you're a perma bear. It's like, no, again, if you have an IQ greater than 80, you can see that plenty of times I've been bullish in the past. But unless the thesis has changed, and the thesis has always been around the lags against the magnitude of the rate hike, I still think the risk is there. The fact that so many people seem to think it's not just because it didn't happen in November, which was a monster month, which, by the way, plenty of bear markets have monster months. To me, it's like, I don't know, that seems like that's the setup for how you have a credit event when nobody's thinking it can happen again, all right, when the risk seems to have gone away. This is a thing, too, also, which drives me kind of crazy. So a lot of noise was made about the Dow Jones Industrial Average on a total return basis made new highs. So it's a bull market there, right? Okay. I keep going back to, yes, technically that reset the drawdown in the Dow. You're still in the drawdown for the NASDAQ. You're still in the drawdown for small caps. Definitely in the drawdown for small caps. Still in the drawdown for the S&P. Okay, but what about inflation? Right? I mean, that prior peak for the Dow, for the S&P, for the NASDAQ from 2021, it's not in nominal terms. What's the real level, the after inflation level? You still need like another 12% from here for the NASDAQ to technically be at the real after inflation adjusted high from 2021. I'm not saying it can't happen. I'm just saying, for all intents and purposes, we're still in the drawdown. We could still be in a bear market. And you only know if you're in a new bull market after you've taken out the prior peak, which means you only know if it's with hindsight, right? But again, credit events tend to end bear markets. VIX spikes tend to end bear markets. You have not had that in equities. And if I'm right that the credit event is still out there, that we're still in a bear market, it's going to frustrate a hell of a lot of people, and that's what stocks do.
That I couldn't agree more with. So thinking about the credit event possibilities still, the way that things have unfolded thus far, what are the primary catalysts that you see on the horizon that could kind of capitulate us down that route?
So this thing, there really are like a legit number of catalysts, right? I mean, the ones that have been, talked about and ones that are not getting as much attention. So obviously there's the commercial real estate side of things. I don't think it's going to be as big of a catalyst because that's not all at once. China could still be a catalyst with the real estate crash that's going on there. Our own housing market could be a catalyst, right? If that kind of creates a sort of self-fulfilling sell cycle. Everyone seems to assume that you have to go back to 3% mortgage rates to unlock this kind of lock-in effect. It's like, it's not true. Well, you go mortgage rates go to 5%, you're going to have people selling. Even 5.5%, they're going to sell, right? They're going to unleash, because the reality is Yeah, they're locked into their home, which means they're also locked into home insurance rates. Like that's going up. I mean, you can see that with the stories around Florida, right? All these home prices, went through the roof. All these property prices went through the roof. They have this lock-in rate with low rates, but the insurance costs are going through the roof. So it's like, all right, I mean, what do you do, right? I mean, you're going to keep on paying the insurance. You're going to try and sell just because you have the 3%. Is that enough? So that could be a catalyst. I still think Japan is the real big catalyst, right? If they're going to try to, in quotes, normalize their own policy because of inflation, you talk about a country that has been a source of leverage for the entire world for 30 years, now tinkering with monetary policy in a more aggressive, tightening type of way. That could still be a catalyst. But the point is, it could be something nobody sees coming. But the condition for whatever does come still relates to the fastest rate hike cycle in history and the lag, right? That's all I'm trying to stress by providing a different way of thinking about it. Now, you and I both know having a thesis is one thing, trading is a whole different thing, right? And I make this point continuously. I do not believe in shorting. I do not believe in going into cash. I do not believe in buying puts. For me, and I've said this and it's outlined in the papers, the risk-off expression is still to be exposed to something on the long-only side, right? And outside of the options market, the way you do that is by either being long gold, which is working, being long treasuries, which is starting to work, being long the dollar, which has worked the longest as a risk-off trade, or being long utilities on a relative basis, right? That's your risk-off opportunity set, right? So you can be bearish and be long those, be wrong being bearish, but still make money. You can be bearish, be long one of those, and make money. But the point is that it's not a guarantee either way. And that's why it tends to be a better way of expressing defense than making an outright directional bet, saying stocks are going to go down, credit event, short it if you have conviction. I don't have conviction in the mile marker. I have conviction in the conditions, right? The catalyst could be the pebble on the road that nobody sees as they're driving. You're not going to swerve because you can't see that catalyst, but you know that you need to already be slowing down before that pebble hits you.
I think the way you described it there makes a lot of sense too, in that it's not necessarily, what is the last thing that tips us over, but we're at a point where any one of those things potentially could.
Right.
So when we look at something like the housing market, and I was looking at something where back in the 80s, the median home price was like 3.7 times that of the median income. And as of November, it's like 5.5 to 6 times the median income. What role do you think the housing market plays in the way that this unwind occurs, if any?
So even the Fed has said that the wealth effect is most powerful when it comes to housing, right? I mean, we talk about the stock market and the wealth effect for stocks, but the reality is it's most people's asset is their home, right? We're privileged to be able to trade and own stocks and to play that game. But the reality is most people don't, right? Their wealth is their home. Okay, so to the extent that housing appreciates, it makes them feel more confident. They spend more. If housing depreciates, it makes them less confident. There's a reverse wealth effect. They start paring back, right? You haven't seen that yet because housing is only now starting to roll over. I've been early on that, by the way. I said continuously, housing is, I'm not going to use the word, but is in trouble. Obviously, I've been wrong on that, but again, fine line between being wrong and early. Plenty of people were wrong in 2006, warning of a great financial crisis at the housing peak back then. They were wrong until they were right, right? Which is just, it was a 2-year lag, right, from 2008. So if housing is going to keep on weakening, if there is going to be this depreciation, yeah, that's going to challenge the consumer. That's going to challenge small caps. It's going to challenge the likelihood of the zombie companies, which have high leverage and low margin, to keep up with higher costs of capital because the revenue side gets challenged as people spend less. That's not a perma-bear argument. That's cause and effect, right? Now, maybe that doesn't happen. Maybe housing holds or goes sideways. Maybe it's a correction in time. Okay, it's possible. But, typically extremes don't resolve themselves sideways, right? And the appreciation post-COVID in housing isn't extreme on an annualized basis, right, nationwide. So we'll see. I think that is a headwind for a while. Again, maybe it's a catalyst, maybe not. It's not a catalyst in the same way as what you saw with the 2008 financial crisis, but as a catalyst that breaks consumer spirits, yeah, I don't see why not.
Do you factor things like auto sales coming down or things like credit card defaults going up? I actually, the beginning of this earnings cycle, I trade earnings, right? So I'm an options trader. So unlike you, I have no loyalty, long, short, whatever it is, dog, I'm there. But I did notice when the banks were reporting, I always like to read through their reports because you get a lot of information, and they have a really significant spike in credit write-offs from people defaulting. Do things like that factor into your thesis as well, or are those just kind of just additional supporting metrics that move us further along this path?
Yeah, I think it's supporting. It goes back to that point about the lags, right? It's like, look, it takes time to change a habit. I mean, you know this yourself, right? I mean, given the success you've had in your life and your career. So if it takes time to change habits, consumers don't change their spending habits overnight. It takes many months of seeing the minimum payment on their credit cards rising. It takes many months of them seeing the minimum, just in general, just how much the rates are rising for that to actually impact how they're spending. So, and then suddenly they're surprised by it, and then the delinquencies start to kick in, right? It's like I use that line slowly, then all of a sudden continuously. Because that's how this works. It's like a slow burn, and then suddenly the fire is there. So I think all that is supportive of the idea that, yeah, the credit side is straining consumers, right? And again, maybe it doesn't resolve itself in an event. Maybe it's just a long drawn out, pressure problem for the economy. But to deny the cause and effect of rates on consumer spending, and by the way, on retailer stocks, which I've been telling you for the entire year, consumers are strained. For all the narratives around how strong the consumer is, tell me why retailer stocks have gone sideways in a pre-election year. Tell me why small caps, which are more sensitive to the domestic economy, have gone sideways. I get the regional bank, effect of it, but like even the stock side is telling you that these delinquencies are only starting. So how else do you explain the performance being so poor on a relative basis to the S&P, to the Nasdaq? So, yeah, I think it's foolish to argue that we're in an expansion phase just because the Fed is now maybe done hiking rates, because history shows that when the Fed is pivoting, it's a contraction phase. It's not an expansion phase. It doesn't have to be. It's not every time, but this is a game of probabilities, right? So volatility should be increasing. Delinquencies are the first step to that.
Did you see Powell's statements today when he was talking about he thinks it's, I don't want to misquote him too bad, but the paraphrase was that it's too early to say that hikes are gone. What did you make of that? Is he just playing hardball as per usual? Or because to me, I looked immediately at bonds to see what they thought, and they think he's full of shit, but No.
So it's interesting, right? The moral suasion is a tool for the Fed, right? Words are a tool, right? Because they obviously impact rates. I suspect that Powell probably is concerned about the stock market running away to some extent. Why? Because if the stock market keeps pushing higher, it will delay the disinflation that comes from housing. So one of the arguments for why I think housing has been stubborn on the upside is because a lot of people saying, okay, yeah, so mortgage rates are 7%, that's fine, but I got NVIDIA. Right? Like they view their stock portfolio as something that can help pay off those higher mortgage payments. So I suspect that Powell does not want to see the stock market in an enormous melt-up phase, because that's going to cause all kinds of other liquidity, inflationary pressure, and then cause them to have to hike rates again. So I do think it's a game of trying to just manage expectation on his end. Now, to your point about the bond market saying he's full of shit, of course he's full of shit. Of course he's full of shit. He's full of shit because he can't tell the future better than anybody else. I mean, if you look at headlines of Fed projections for hikes in 2018 to 2019, they were expecting 4 hikes, and then they ended up cutting instead. It's like the Fed doesn't know what's going to happen next either, right? And the Fed is a follower, I always go back to that point. The Fed doesn't own the bond market. The bond market owns the Fed. The fact that the long duration side is acting like this, okay, yes, it's over. It was oversold. Yes, it was due to bounce, right? And I stress that long duration trade finally kicking in. The Phoenix Rising idea, the flight to safety has not happened yet because credit spreads haven't widened yet. But it does seem like the long duration side is saying the Fed definitely over tightened, which means that he can say that they're not done hiking rates. But at the end of the day, the Fed is the bond market's bitch. I'd say it that way, but that's just the truth. The long duration size bitch.
Right. Before we move on from the credit event, there was somebody in the chat from the Twitter space that was saying, can you share 2 to 3 concrete examples of what a literal credit event would look like?
So any VIX spike, I'd say above 30, you can see that. So if you just Google Fred, right, and then VIX, and then OAS, Fred, VIX, OAS, those 3 terms, I think it's the first link that shows up. You'll see that chart that overlays the VIX against credit spreads, and then the shaded areas of recession. And you'll see, again, there's a 1-for-1 relationship, right? So, it's like if you're going to be mathematical about it, it's literally just that, right? You had a credit event with COVID. You had a credit event in 2008. You had a credit event in 2011 with a summer crash. You had a brief, what looked like a little bit like a credit event in November, December 2018. Right. But basically, anytime you have a significant VIX spike, that's basically what a credit event is, because you see spreads widen. Right. Again, it's if you believe, I put that poll out yesterday. Right. I said, do you believe that you're going to see a VIX spike in the next 3 months? And something like 70% of people said yes. The next post down, I said in that is, if you believe that you're going to see a VIX spike, you have to believe in the credit event thesis, because it's the same argument. You're not going to get a VIX spike and spreads stay tight. That's not how it works. Right? That's my point with this. Again, I've been wrong on the timing. I don't think I'm wrong in the reasoning.
Well, and I think some people, at least based on the way that this person was asking that question, it looks like their name is Bull for now. I kind of get the sense by the way that they ask the question that sometimes people, when you say something like credit event, sometimes it feels like people are thinking like they're going to see fire in the sky, right, and that it's going to be end of days.
Yeah, no, of course not. Yeah. Right. No, of course not. No, I've said this many times before. It's like, if I'm right, that we're still in a bear market, which I know sounds crazy, especially now. A credit event ends it. A VIX spike ends it, because historically bear markets do end with a bang. They end with a capitulatory move. Speaking about like tech analysis, well, I always poke fun at the squiggles. Right? I say I use that term. The basement traders using squiggles, right? Okay, fine. It's not that I'm against tech analysis. I'm just against things you can't backtest. Right? And most of these, in quotes, squiggles, you can't backtest. But one thing which is very well known that you can backtest is extremes. Right? The capitulation that happens at the end of a downtrend. Capitulation is a VIX spike. Capitulation is a credit event. It's where junk debt falls apart relative to AAA. We have not had that in equities. This is just fact. Maybe we don't, in which case I'll be wrong. But probabilistically, I think it's a higher possibility than not. Now, if I'm right about that, that brings back what I've used that line before. To save treasuries, you have to crash stocks, right? And people seeing the treasury move the last month are saying, oh, obviously it shows you're wrong. No, it doesn't, because the top 1% of declines on using daily data for the S&P treasuries are positive, and the biggest declines for stocks. I mean, this is just fact. So if I'm right about that VIX spike, that credit spread widening, which is still to come, okay, then you know what? Yeah, you're going to see some really interesting movement in defensive areas in advance, because those tend to move prior to that occurring. And you're going to see junk debt break down, which would be a great opportunity to buy into junk debt. Like, I want to see a credit event selfishly, not just because, candidly, for my own funds, they're designed to play the flight to safety trade in treasuries, which the credit event is kind of needed for that to kind of get shocked back into place. But I want to buy at cheaper levels on the risk on side. Who wouldn't? I don't know. I am blown away. It's like, if you're a real investor, you want a credit event, because time's on your side. You want to buy cheaper. It's not going to stay down. I never said it would stay down. A perma bear would say it would stay down. It's not.
So there's a couple things that I wanted to ask you about. The first one is a personal curiosity. Have you, because I know that you study a lot of relationships. I've never studied this one. I've studied tons, but I've never studied this one. Have you found any correlation between when Christmas displays come out and the performance of that company?
No, although it's funny you say that. I had interviewed Jeff Mackey, who used to be on CNBC a lot. He's now covering a lot of stuff on retailer consumer stocks. And he was actually bringing, I'm trying to remember the exact thing, but he mentioned something along those lines where it's like there's a strong correlation between sales related to garden Christmas items, I think it was, right? Like display items for like, the front yard, and future retail sales into the holidays. And it's basically the idea is that like if you end up seeing people not buying a lot of things like lights and all these things for their front yard, that's actually a harbinger of negativity. Right. So I don't know if I haven't studied it from the perspective you're asking, but it kind of reminds me a little bit of that. But is there something you saw on that? I'm curious now.
No, I haven't. That's why I'm literally asking people, because I haven't done that one yet. I'm working on a handful of other ones from this past year on different anomalies. So like I'm trying to outsource some of these questions I have. So
it wouldn't surprise me if there's some effect to that, because like the reality is, look, FOMO is always about sentiment. Sentiment's always more than just a chart. Right. That's why seasonality is a thing. Right. I mean, that's why even moon cycles are a thing. Right. It's ultimately about mood. Right. So I am sure there's probably something there. Whether it's tradable or not, I have no idea. Right. But I don't know, man. It's like I'll give you one which I think is just more kind of anecdotal and interesting. Somebody turned me on to this app, Temu. This app which is like it's like this number one app on the iPhone. It's there's tagline, I think it's something like "Shop like a billionaire," and basically it's like all goods from China and at just basically unbelievably cheap, stupid pricing, right? It's like the number one thing. Everyone's just buying things left and right. I mean, a lot of this stuff looks kind of junky to me, but whatever. I mean, that's fine, right? It's just a way to get very cheap items. And it's like, all right, I mean, I find it interesting that we're at a point now where consumers are just so desperate for anything that's cheap because they probably can't afford very much with inflation and with credit card rates and credit card balances. Like that to me is actually an interesting contrarian signal that you have so much demand for this, Temu app and these types of products because they're just people are desperate to have something because they can't afford anymore just going to the prior alternatives like Walmart and Amazon to get their stuff.
Isn't it pretty crazy? I was just talking with my wife about this not too long ago, though, how insanely good consumers tend to have it now, where if you want to buy something, you literally can just go on Amazon and grab it and have it sent to you in a couple days. Or if you want somebody to go get your food, there's DoorDash. It's like, I feel like the average person literally lives like a fucking king or queen at this point compared to what it used to be. Just what you're talking about with Temu is making me think of that, because there's people that can just buy cheaper goods directly from China across the fucking globe now and have it shipped over, which is pretty sick.
Yeah. And by the way, I'll say on that, it's like people also underestimate how that convenience has a price in terms of their discretionary budget. It's like, oh yeah, sure, I can just press this on Instacart. Meanwhile, it's like what? What's the markup on the percentage, right? As opposed to just taking a walk down the block and buying it. Right, you're just having it delivered. So my point is like, we're so used to these luxuries, but these luxuries still have a cost to them, right? Which only furthers the strain on consumer budgets at some point. But they're so used to now ordering and taking advantage of those luxuries that it's hard for them to walk away. They'd rather just be in more debt.
I could not agree with that more. I was actually just thinking about that before when I was thinking about going to the grocery store and like I literally use Instacart, and I was just like. I remember thinking like, oh, I'll just order it on Instacart. And I was thinking like, since when is your time that fucking valuable? Like you can go to the damn store, dude. Yeah. Like, but it's
and get some exercise out of it. Let's take a walk. Listen, I haven't been eating very much. I have not been eating very much because I'm doing the fasting thing as it made sense. But it's like, now that I have that mindset, right? I talk about like being an outlier. Right? I mean, you're super healthy and fit and all this, and for me, it's like, all right, if I have an opportunity to walk somewhere, I'm going to walk.
Smart. Yeah, it's super smart. And I don't know, I find anytime that like I travel, one of my favorite things to do is, I say it jokingly, but it's like to exist. Like when I was in Africa, you spend a lot of time just finding somewhere to go to get food. Like that is now an actual activity that takes time and effort. And you just kind of enjoy that. And it involves a lot of moving around and whatnot. So yeah, tell me, how's your fast? I've been doing, I eat one meal a day. I've done that for a long time now.
Okay.
Yeah, it's, and I do not tell anybody that I do it because like I'm fasting or I'm trying to do anything. I think based on my genetics, it is my disposition because my uncle eats like this. My dad, before he died, ate like this. It's just how a lot of the dudes in my family are. I vastly prefer it. I think I went through college. I was force feeding myself trying to put on size because I was working out a lot. Like I literally was at the point where I was blending chicken breast and drinking it. So I got really sick with food, and now
How'd
I
that
don't
taste? How'd that taste? Blending chicken.
terrible.
Yeah.
Fucking terrible. As soon as I realized how dumb I was and that I should have just been eating like tuna out of the packets, I was the biggest village idiot that I didn't have to drink blended chicken. But, anyways, I learned quickly how dumb that is. And so, anyways, I prefer this structure personally, but I'm curious how you're finding it.
Yeah, no, I didn't know you did OMAD one meal a day, but yeah, I mean that's how I started. Right, I did OMAD, intermittent, basically extreme form of intermittent fast, and I did done a couple extended fasts, like gone as long as 4 days. Well, I should take that back. Technically 5 days, but there was a little. You're not supposed to have, you're not supposed to have like creamer with coffee because the moment you have cream, it kind of breaks the fast. But so that's why I paused there. But it's. I mean, I've lost quite a bit of weight. I feel healthy. It's. I'm not done yet. I think it's a great lifestyle, and it saves a lot of time. Like I'll tell you something. That's the thing that actually was the most surprising part. It's like people underestimate how much time they spend cooking, ordering, eating. Like talk about being an outlier. If you're going to be an outlier, you're going to be really time efficient, not just healthy. And if you can do both, you're going to be ahead no matter what, right? So I'm a big fan of it. I think it's not health advice, but I think people should learn more about it. I didn't know that much about it myself until I started doing it. And that's one of those things where the targeted ads on X actually worked because for whatever reason, I started seeing ads on intermittent fasting. I was like, all right, let me look into it. Started watching some YouTube videos, listening to podcasts. And going back to the point, simplest answer is the right one. Just don't eat. Right? And you know this yourself, right? I mean, I'm sure, as the day goes on, once you have that one meal, you get really focused. Right? You get this kind of like superhuman ability to just really be centered in terms of whatever you want to do. And it's true that the more you eat, the more you get distracted. Right. And there's biological reason for that. You go back to our ancestors. It's like, all right, if you didn't eat for a while and you were caveman, your body said you better go out and hunt. If you're going to go out and hunt for meat, you better be focused. Right. So there's a lot of interesting, like even DNA, genetic aspects to it from like an evolutionary perspective that I think are fascinating. Look, I started doing it even as it relates to me as a portfolio manager of funds, right? Nobody can control the value of their portfolio. I don't care what anybody says. Nobody knows day to day what their portfolio is going to do, right? I always go back to there's no gurus, only cycles. Certainly in my world, the cycle I need is that risk on, risk off, flight to safety sequence, credit spreads widening, treasuries working against equities that are going down. Okay. I can't control that. I have to only wait for it and hope that my funds, with their rules-based approach, the signaling, get it right. So when you're in the business of product development, bringing strategies to market, like I am, you recognize you can't control the outcome of the portfolios. You get assets because you're performing in your funds, but you can't control that. So you actually feel pretty helpless in these periods, right? It's like, shit, I'm working so hard. I'm putting all this effort. I'm out there. I believe in what I built, but it's day after day after day. You're waiting for the light to change. So I said to myself, all right, if I can't control the value of my portfolio, if I can't control my career, which is dependent upon the cycle that I'm in, that I operate in, let me control my health. Let me control what I'm putting into my body. And then I started making a point. I go out every morning. I wake up at 5:30 now every morning. And I go out and I walk to the gym. Right? And I'm just every single day and no days off. I'm going to the gym. I'm doing a long walk, going to the gym, lifting. I'm doing it at an older age, right? But not terribly old, but certainly not like you, right? Back in college, I was not that kind of guy. So I think that mindset is helpful because at least for me, it kind of keeps me sane as I'm waiting.
I think, well, and it's also very stoic of you, right? Because I'm a huge studier of stoicism. I came across it mostly during COVID. Marine officers, we always like to think we're stoics, but most of us don't know what the fuck it is. But I started studying it a lot, and it talks a lot about sphere of control, right? Which is exactly what you're talking about there. But one of the things I find really fulfilling with any sort of like physical endeavor is that once you can literally force your comfort seeking side of your mind into submission, to literally submit to your will, it's actually very powerful, because you start to realize how frequently on a day-to-day basis you are just acting off of subconscious impulses because your body is trying to offload as much thought as possible. Atomic Habits goes into a lot of this, which is a great book by James Clear. But yeah, I'm actually really stoked for you, because I think there's a lot of great things that come out of that. And then, I mean, working out just for resilience, like literally just, you don't have to be like super strong or anything if you don't want to be, just for general resilience is good. And yeah, I think that that's a massive change that somebody can make in their life. Now, before we pivot too far away from the funds stuff, I did want to talk to you about that, because that is one of my favorite things to pick your brain on, because that's not something I've done, right? I've been a retail trader for my whole life, so I am completely ignorant to that world. When you were deciding your funds, did you have a thought that, yes, I'm going to make this fund, and this fund? Or is it more of a, oh, this one seems like a good idea, and then it sprouts the next idea, and like so?
Okay, so good question. So ideally, this is now from the business side of things, right? I'm an entrepreneur, right? And I did launch my funds at the exact wrong time because the cycle didn't favor the risk off opportunity set with treasuries the last 2 years. The idea is you want to build a fund family, right? So diversification is not just about what you're trading. If you're an entrepreneur, you ideally want to have a diversified number of funds, because the reality is, going back to, you can't control the cycle, right? You want to ideally have, I hate to say it this way, but it's truth, you always want to have something that can sell. Like, that's just the reality. Meaning something that is likely to perform well while other things are maybe not performing as well. Because you're trying to build, you're trying to get assets, you're trying to get people to pay attention. I mean, that's what all these fund complexes do. They have multiple funds, and a cycle doesn't favor one asset class, but the other asset class works. Okay, so I always want to build out a fund family. The commonality of all the funds is that they all rely on treasuries, right? Which you can argue was my critical flaw in the development, but it's all for good reason based on the hindsight data of how treasuries tend to act, right, against equities. But the signaling actually tends to be different. So I designed the other funds to have a correlation that's fairly low against each other. So I've got my mutual fund, ATAX, my two ETFs, RORO and JOJO. On the indices for RORO and JOJO against ATAX, to look at the fuller history, the correlation when I ran it was about 0.33. So I was trying to create a fund family that was inherently risk on, risk off in concept, but actually not that correlated to each other, except when you're in the real risk off periods where they would likely all be in treasuries and play defense, right? It's challenging to bring three funds to market which have a correlation of 0.33 to each other, at least, based on that history, and then be in the one period where they're correlated to each other, because again, they rely on treasuries, right? I'm hopeful that's over, but it was a purposeful decision on my end. Now, I designed all of my strategies to avoid large drawdowns in equities in the risk on asset by being in treasuries during those drawdowns. I did not design the funds to avoid drawdowns in treasuries. By the way, that's nearly impossible to try to avoid drawdowns in both systematically, because it almost never happens. It's just fact, right? Pre-Volcker, post-Volcker, it doesn't matter. I can show you the data on that, right? So, and if I could do that, then I have the perfect strategy, because it means we'd never have a drawdown, basically, if you can constantly kind of wiggle between the two. So, brutal period. By the way, every asset class at some point goes through a lost decade. I don't care if it's commodities. I don't care if it's gold. That's part of commodities. I don't care if it's bonds, like we've seen already. I don't care if it's equities. How many lost decades has the S&P had, has the NASDAQ had? Like everything. And by the way, active strategies have lost decades. So I went through a nasty drawdown out of the gate with what happened with Roto and JoJo in particular, because I launched them just before this treasury, nasty bear market started. The signals were right to say risk off, but risk off didn't work. Treasuries didn't work, and it's rules based. Now I am stupidly optimistic because I think the cycle is going to come my way. Could be wrong, just like I've been wrong about the credit event so far. But I know that every day that goes by, I'm closer to being right. That's what keeps me optimistic. And now combined with the fasting and the health, it's like, all right, I'm even more energized, like physically, right? It's like, yeah, let's go. I'm ready to go. I'm ready for this thing to start picking up again. Roto's done very well this year. It's up, I think, year to date, like 25, 26%, right? Even though I haven't had the risk off period. If I get a risk off period, which may still happen into December, all right, we'll see. It'll surprise a lot of people, not me, because I know how this can work. But going back to your original question, you think about it from a business perspective, you want to have multiple products that are not correlated to each other on the hope that at least one of them will work. It so happens in the cycle, none of them worked.
Now, how did you align that you wanted to stick to long only versus either shorting or using derivatives? Because to me, it does seem like the more pure style hedge, at least if, we want to hedge downside from a long delta portfolio or something like that. So how did you think about that?
Yeah. So it's actually, this is an interesting thing to talk through. I would argue that you don't want to have a perfect hedge. You don't want to have a perfect hedge would be what? Perfect hedge would be, inverse, right? Shorting. Okay. What's the problem with having a perfect hedge? Your timing has to be perfect, right? It's like, the exact mile marker, something's going to happen. So you take a directional bet. Okay. If you do any kind of a long series back test, I don't care what signals you're using, right? What happens is you will inevitably get a false signal, a type 2 error, right? Meaning your signal says play defense and the market goes higher. Okay, so if you're in a type 2 error in a false signal and you're short, you lose money 1-for-1. The perfect hedge hits you because your timing was wrong, right? Same problem with cash, by the way, right? It's like, why do the studies show that market timing doesn't work using cash? Because cash has no momentum. So if you're wrong and the market goes higher, you're missing out. You're not compounding, right? That's why studies show market timing doesn't work versus buy and holds, right? Whereas if instead you use an imperfect hedge, which would go back to things which benefit historically from stock market volatility, not direction, volatility, the flight to safety trades of gold, the dollar, utilities, treasuries themselves, you can be wrong in the timing, meaning you could play defense in either one of those four and the market goes higher, but you can still make money because you're not inverse to equities, right? So it's really the function of, and this just comes from my years of just backtesting strategy development in general, the opportunity set with which you express being wrong will matter more than being right, right? And yeah, you can be really right when you're short. And I'm sure a lot of people, I'm sure you included, make some good money when you're making a directional bet. But if you're going to try and do that systematically over time, I would argue you're going to eventually have those streaks where that perfect hedge kills you perfectly. And you're better off then playing something else, right? Now, I get it, right? If you had done shorting or cash the last 2 years, you did way better than playing defense and treasuries, obviously, because treasuries got killed. But that's an anomaly. It's an outlier. Speaking about outliers, right? That doesn't happen. What we saw with treasuries is a once in a multi-generation move. I'd rather bet that that's going to come back to being a better hedge going forward than we've ever seen, in the last 20 years.
Have you considered something like volatility products, though, that you could still trade long?
The problem with that, as you know, is that it's no different than shorting in that you're betting against time, right? In that case. Now, obviously, you can get convexity, right? I do think if you were going to try to do something like that, you want to do it. You want to allow yourself to be wrong cheaply, which means, and that's where, in your world comes into play. If you can get out of the money puts and they're really mispriced and cheap, and you get a risk off defensive signal, okay, that I can be on board with, because it's not really a directional bet. That's an insurance bet, right? I'd argue that's a different kind of hedge where you're not going to lose big, right? With a small amount with a convex payout. But I mean, it is true that this way you never see really a very rich short seller. I mean, other than Jim Chanos, I mean, who else has really kind of is out there known as this kind of killer short seller? That's his mandate or her mandate, and they just make a ton of money. It's very hard to do because again, the timing has to be perfect. It goes back to path matters more than prediction. And then let's go back to the November, first week of November point. I said circuit breaker was likely. Okay, but I never said short. I said my strategies were in treasuries. TLT, I think, was up like 4% that week or something like that. So you wrong in the idea, in the direction, still made money. I'll take it.
I was actually looking at the humor of it all, to be honest, just to take an opportunity to put a little bit of salt comedically in your wound. And I started entering TLT on the 2nd of November and then on the 13th.
Yeah. And it's been working.
It's been very nice. But it's the reason why I think that's so funny, obviously, is just because you are following, and that's actually why I find your approach so fascinating to me, with like a rules-based approach. Because one of my arguments against retail traders, there's this thing where retail traders say like, oh, I want to be mechanical, I want to deploy mechanically, and it's sounds so great, right? It sounds super cool. But unfortunately, I genuinely don't believe that that's how that works super well, as far as I can tell. So I look at the way that your funds are designed to perform, and it is really curious how you handle uncommon events like this. Now, I don't know if you follow much of Nassim's work or just that style of thought where we think uncommon events are actually far more common than we tend to price in. Is that something that you think about with these funds in any capacity going forward, or do you think that will still normalize?
So I'm a big fan of actually Talib and Black Swan and Fooled by Randomness and all this stuff. The what I would say is like the last 2 years have been the outlier. Like that's just fact, right? I go back to I don't care how many people on FinTwit, FinX, on social media, in the media say anybody could have seen stocks and bonds would lose money. How could you launch funds knowing that was going to happen? I had somebody actually say that to me. It's like, are you kidding me? It's like cost $250,000 to bring a fund to market. You think I want to just spend that money?
Yeah, right? Yeah, just for fun.
Oh yeah, let's just see. Maybe I'm gonna be wrong. But let me take the risk on and put a $250,000 chip, right? As somebody who's skin in the game. Okay. So, okay, fine. Let's say anybody could have seen stocks and bonds would lose money. Could you have said that stocks and bonds would lose money while credit spreads would stay tight? While default risk would not increase in the fastest rate hike cycle in history in that dual sell-off? Give me a break. And nobody would say that. That's crazy. Let's talk about outlier. The outlier was not that stocks and bonds fell. The outlier was how it happened. The path, the interaction, the knock-on effects to credit spreads. That's what made this an outlier. Because that's why treasuries didn't counter high volatility sequences, the flight to safety, which is what I built my funds on. And no one is more tuned into that than I am because I have skin in the game and I built funds that I know the research around it. So I know how anomalous that is. Now, look, you do any kind of back test on any indicator. You go back to the 1920s. You will always have periods where it's not working. By the way, just like you have periods where buy and hold S&P is not working, where it's an outlier on beta. You're always going to have that. You're always. I mean, I challenge any, and if you don't have that, you are Madoff. You've done something wrong in your modeling. There's no such thing as somebody having 20%, 20 years of no negative returns. And if you do have that, okay, then you are a probably more lucky than skillful. Because in any statistical data set, you will always have an outlier. And the outlier can be luck. In our business, especially, because you can't control your portfolio, so it's skill and luck. So maybe it's more luck. Okay. So when you're going through these cycles, the reality is you have to just take it. You have to wait for it to change. Right. And in my case, I don't have a choice. Like the funds have a prospectus. I designed them this way. Right. So it's like, and this is also what I think the retail community, when they look, I mean, I put myself out there a lot and I communicate a lot and I'm loud and aggressive and obnoxious on social media because it gets attention as I'm waiting for the cycle to change. It's just the reality. I have to play that game. I keep saying it's a persona. because anybody look at the funds would say, why should I listen to this guy who's this professional CFA charter holder, but man, he can make me laugh. Like it was a communication bet when I did that pivot. But when you're going through that hell, you got to keep going through it. Right now, if you're a retail trader, if you're going through a streak where it's not working, you have the luxury to step away. You have the luxury to not have a mandate. When you're in the business of investing and you're a fiduciary and you have a strategy that you hope will be different than every other strategy that's out there and competes against a very crowded mutual fund and ETF space, you can't do that. Right? You're designing something for a particular environment that you may not be in, but at some point will come. Right? So going back to the question, what do you do? Not much. You just have to wait and hope. It's like people say hope is not a strategy. It's like, no, I disagree. Hope is unequivocally a strategy. If you don't have hope as part of the mindset of a strategy, how can you wait for the turn to come your way?
Well, it also dismisses the concept of luck if somebody thinks that there is no hope, which
of course.
I would definitely argue against. We're coming up on time here, but I do want to catch you with one more question before we go. Looking back over 2023, a lot of interesting things happen, and I feel like you put out a lot of content that talks about a lot of those events. But I want to pivot us to 2024. Is there anything in particular as we look into the next year that you're interested in or that you think could be an interesting catalyst or an event to watch?
So I historically, it is true that small caps tend to underperform in pre-election years. Not to the extent that we've seen this year, the magnitude. But it's true that in pre-election years, large caps do tend to outperform small caps. In election years, though, which is what next year is, small caps do tend to outperform large. So I think from an asset allocation perspective, there is an argument to be made that next year will not be the year of the Magnificent Seven, that it'll be the year of SMID, small and mid cap. All right. So it's like if you're going to play equities, the catch-up trade, which everyone talks about, probably does manifest, right, next year. The question becomes the sequence. In other words, does it happen at the start of the year or after some kind of capitulation credit event, which I still think is the more likely near-term scenario, right? But I think that's probably the real area to kind of pay attention to, right? It's just that play the laggards. That's probably going to be the biggest leader. I also think that there will be a lot of demand and money rotating anyway from a sector perspective into anything that's dividend oriented. Right. So dividend, as you know, dividend stocks have not done well, right? On a relative basis, utilities have gotten smashed relative to the S&P. Why? Because utilities, a high dividend paying sector, has been competing against the Fed as far as income goes. Same thing with consumer staples, same thing with healthcare blue chips. If the Fed is done, which it seems like they are, and if you get any kind of heightened volatility, you would expect that defensive sectors, which are high dividend paying sectors, utility, staple, and healthcare, probably get some relative strength as well. So there's two trades, right? There's the defensive sector allocation from a large cap side, utility, staples, healthcare, and then there's the cap rotation from a small cap side, right? Which I think both can work. The thing I'm most confident in, which I could be totally wrong on, is that we're probably not going to see this large cap dominance like we've seen, the last year. That part of this cycle is probably towards the end. Doesn't mean that we're going to all collapse. It just means it's going to be finally rotational and hopefully allows those that are actually benchmarking against the S&P to beat the S&P, because guess what? You can't beat the S&P as an asset allocator if it's the only game in town. You need to have other asset classes leading and outperforming. That's been what's been so maddening about this cycle, because it's been all market cap at 7 stocks driving the whole thing. That's not just me saying that, by the way. I talk to financial advisors all day long. That's them saying it. It's like any kind of diversification has sucked this year. It has not been a free lunch, right? It's been a vomit.
Yeah, and I feel like that's the nature of diversification, right? There's always an opportunity cost associated with it. I am curious to see how tech continues to perform. I'm glad that you highlight that. And then also small caps, for anybody that follows like my YouTube channel, I trade IWM a lot. So I definitely am kind of looking for a very similar movement as you're talking about, which I actually find interesting for that thesis. But Mike, you're always super gracious with your time, man. I'm stoked to have chat with you. I'll throw links to kind of everything that you have in the notes below. But for the people on the YouTube channel side of things, if you have a specific spot that they can reach out to you, where's that?
Yeah, I mean, on all the major socials, at Lead Lag Report on X, YouTube, Instagram, leadlagreport.com, also on Substack, and then the funds, which are separate. I always stress two legal entities, atacfunds.com, with the caveat that the funds have not done well. But, there's a, I always go back to mean reversion is the only thing you can say is close to guaranteed. Nothing's ever guaranteed in markets. The closest thing to a guarantee you can argue is mean reversion. Now, you can debate where the mean is, right? Where the average is. But it's like mean reversion is a concept that's as old as the Bible. I always go back to this analogy. He who is first shall be last, and last first is mean reversion. That which lagged leads, that which leads lags. Right? That goes to sectors, market cap, also goes to funds. So I'm hopeful that my mean reversion for those strategies is about to kick in. But I'm sure either way, whether it does or doesn't, I'm still going to have people I'm going to block on X relentlessly.
That sounds about right. And I will be there enjoying the show as I typically do otherwise. But Mike, thanks so much for hanging out, man. Thanks for being on the podcast. And for everybody else, check out the notes below and you'll be able to find them on all those different spots. But till next time, we'll catch you later, man.
Appreciate it, man.